Hello and welcome to the Trading Zone. I'm Joe Teague of Equity Armor Investments, Portfolio Manager. Great to have you with us this week. Hope you had a great weekend. Great Father's Day to all of those fathers out there. I'll be flying solo today. Brian will be back with us next week, and I hope we're going to have a great trading week ahead, and it should be a fun one. And let's get right into it. And today we'll be talking about the bond market, and specifically bond market volatility. Of course, that's what I love to look at, is volatility. Last week, we had the CPI coming in. We had the Fed decision. So not surprising, volatility came in. And I think that's going to be really crucial for us to watch. I'll dive into it later in the show. This week, not nearly as much market moving news as last week. The retail sales, some people are looking at that. Flash PMI, that might be critical. But I think we'll be more following just the trend in the market and volatility. And it has been volatility to the downside. The market's been going higher. And wow, this trade, the AI trade just continues, starting to branch out. I'm starting to love what I'm seeing. Apple, they're having they had a huge announcement last week. Stock went soaring higher. I'm going to be trading Apple later in the show. Stay tuned till the end to check that out. But as we usually do, we look at the skew index. This is still on the lower end of the range, not giving me a huge contrarian clue either way. It looks like volatility is going to be trending higher in the short term. Not surprising when you see the VIX and the spike index down around 12. So it makes sense to think that volatility will be coming higher. And let's take a look at the VIX futures like we do every week. And yeah, certainly 2 months ago really stands out. Volatility was way high 2 months ago, up around 18. It's come down as people have come to grips with how many cuts the Fed is going to give us this year. We're settling in on 2 cuts this year. The market seems to be okay if there's only 1. They'd probably like it more if there were 3. But 2 might be the Goldilocks, because that might mean the Fed is cutting because inflation is coming down, not because there is a looming recession, which will cause the Fed to need to stimulate the economy. And another thing we've been following every week, keeping a close tabs on, this will come into our big story too, is oil. Oil is, again, not giving us a big clue either way. It's been trending lower. If it does make a new leg lower, that'll be great news for the stock market, and we'll be watching it. But the big story this week is going to be the MOVE index. And the MOVE index, if you don't know, is bond market volatility. And it has been elevated for 2 years here. We've been in this big range here, really high volatility here. People have been asking, where's been the volatility? Well, it's been in bonds. We've been seeing big moves in the bond market, outpacing what we usually see compared to what we see in the stock market. And we're finally dropping out of this elevated range. Now, remember, this is like way higher than it normally is, right? So volatility for 2 years has been in the bond market has been really, really high. Finally getting some relief last week when we're getting past that CPI in the Fed meeting. So volatility in the bond index is coming down. Let's recap exactly what the MOVE index just real quickly. It's implied volatility. It's the spike index. It's the VIX of the bond market. It measures the 2, 5, 10-year treasury volatility. And the 2 reasons why it might go higher is growth, either growth going too fast or too slow, or inflation too high or too low. So uncertainty in either area will cause volatility to be higher. If you take a look at it with the S&P 500, you can see why it's so good when the MOVE index is going lower. You can see the MOVE index is coming lower here before the Great Recession. This was great for stocks, right? You got after the Great Recession when the MOVE index came lower, another great period for stocks coming here, right? So again, you had the COVID area, another time, and this even happened briefly in 2023 with a spike in the MOVE index and a huge run up in stocks. So this is something that makes a lot of sense. Volatility in the bond market comes down. It's good for equities, but it can be for a couple of different reasons. Obviously, I mentioned where this can be coming from. Certainly, the obvious one is growth, and you think about a recession that comes with unemployment. These times in the past when we've had these high MOVE index has sometimes been with a high unemployment rate. And that's not necessarily what is going on right now. We have a very, very low unemployment. So really, we know the move index is higher because of inflation. And if you dig into inflation, what's really driving inflation, to my mind, that is oil. Okay, so oil and this move index is very closely correlated. They are moving with each other very neatly, specifically even over the last couple of years. You look, when oil goes down, this move index goes down. So that's where this bond volatility will come down. If oil can make another leg lower, that would be fantastic for all the bulls out there of the world. So you might be saying, okay, so if we can get this this move index to make this leg lower and come down here, it makes sense. We'll probably get this upward trend in the stock market. All things are looking fantastic and great. Everything is rosy. Let's get to it. Well, we got to put a little bit of caution out there, and we got to say, wait a second. These PE ratios are very high. Okay, so the S&P 500 PE ratio, we're up above 25. This historically is way elevated, way higher than it normally is. You'd much rather be buying stocks when it's lower. When it gets up here, very cautious, a very, very hard time to buy stocks. Is it really the right time to get into adding to the portfolio here? It really, that's where it really just comes back to the move index. The move index is going to tell us, can we go higher in this PE ratio? Can we make a COVID era high? Can we go back to these previous highs in PE? And if you look at the move index, you can see when the move index is going lower, these PE ratios are going higher. But if you happen to flip it around and invert the move index, multiply it by -1, you actually get this chart, and you can see very neatly when the move index comes down, this PE ratio goes higher. So I think bulls should be watching the move index very closely. If we do get new lows in the move index, we can see new highs in the stock market. We can see higher multiples of the S&P 500. So moral of the story is that we should be ready for anything, of course, in the stock market, as we always are. And for me, it's going to come back to this chart. We've been following this one for a few weeks. We are just in a fantastic trend for the S&P 500. Going back until October of 2022, the market's just been racing higher. It's been in this channel, and at the start of this year, we broke out into a higher channel. So as long as we're in this upper channel, our position is going to remain the constant. We're going to remain the same. We're going to be bullish on stocks here. We're going to be expecting to make higher highs here. If we break below this trend channel, this green line here, we'll turn neutral. We'll be a little more cautious, a lot more selective in our stock plays. So anything below here. And if we happen to break into this red channel down here, be much more defensive, looking for a lot more defensive positioning, a little more aggressive hedges will be taking place there by us. And that's just what we've been watching. If you have any thoughts of your own, feel free to share it. Anything is possible. I'm open to any possibility going forward. Bringing it to the stock of the week. Really, you could have said the stock of the week last week was Apple because of the amazing move they had. They just, announced new AI programs, whole new suite of Apple Intelligence. That's their AI they're going with. And they just have this new hype going on. That's basically all of these AI stocks are mostly hype. NVIDIA is getting really good sales. They've turned that hype into real profits. But the question will be, can Apple turn this hype into real revenue? Now, they've had some slowing sales coming into this AI revolution. Their phones are super expensive. People are maybe looking around and saying, hey, can I get a similar phone? Maybe have a different logo on it, pay a lot less for the same features. Well, if you're going to add on some new features, new things, new needs, new wants, really, that people are going to be out there, they're going to have no problem selling these phones. They're going to go back to the eras of people waiting in line to get the new phone. So I think this is big news for them. And I think that the stock price, of course, was rewarded handsomely for them. And just look at what happened last week. We broke above this previous resistance right about 200, cup and handle, raced higher. You look at this chart and you say, man, I wish I could own it at around 200. Still does look like it could race a lot higher still. And I designed a trade basically off of that theory. I want to own it. I want to buy it if it goes lower. I want to make my call spread a little bit cheaper. Here's what I'm looking to do. I'm going to buy the July 220, 240 call spread, finance that by selling the 205 put. That makes my call spread only 225. So effectively, I'm willing to buy Apple if it does come back down closer to that $200 support area. Love to own it there, maybe even buy more if it happens to do so. And then I get to participate to the upside if we do go higher through July, not expecting much more than another 10% gain through July. If it does, that's great. I'd be happy to pocket my 10% gain. But just a way of making the whole trade a little bit cheaper by selling that 240 call. And that will do it for me this week. A quick show this week. I hope you guys like that. I hope everyone had a happy Father's Day. Brian will be back with us next week. We'll debate it all. But hope this is informative to you. Hope you learned something. If you liked it, drop me a line. Remember, every Monday, tune in 1 Eastern on the Tradier Hub for the Trading Zone. I'm Joe Teague of Equity Armor Investments.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.